What's going on, everybody? Brad, the Mortgage Dad, here with our final video on the road to home ownership. Some final tips, information to get you into the home you richly deserve. So let's get started here, and we're going to talk about the leap to home ownership. So it's becoming increasingly cheaper to own than it is to rent. In economies that we're in right now, rent prices are increasing, where if you had a mortgage, let's just say you bought a house last year, your mortgage payment is fixed. As long as you got a fixed loan, your mortgage payment's fixed and will never go up. Now, it might slightly go up because of taxes and insurance costs that go up, that's built into your monthly payment, but you're not going to see increases like rent sees, where at the end of their term, at the end of their lease, all of a sudden their payment goes up hundreds of dollars. So it is usually cheaper to own than it is to rent. And there's this chart here that kind of goes over with your rent and the cost per month and kind of how much you spend in rent over a time period. The column here to look at is the 5-year column, really, just in renting for 5 years, how much you might have spent. Now, on the surface, this number looks big, but the one thing to also take in mind when you rent is you don't pay for anything if anything needs repaired. It's kind of the offset of owning a house and renting. However, you're not building any equity, you're not saving anything, you're not growing by renting. You're just putting that money and giving it to somebody else to help pay their costs to do everything. So, and if you want to look at it in details, your repairs and stuff that you technically don't pay for is built into your rent cost, and that the landlord is cushioning that rent payment with maybe expected repairs they might have to make in the future. So, another thing with homeownership, predictability with expenses. And, like I said, your payment's not going to change, and you're going to be able to actually budget better on how much you want to save, how much you want to spend every month. And then last, kind of like what I mentioned before, you're building equity. You're forcing yourself to save money by building equity in your house. As the markets increase and home values are increasing, you're saving money without even realizing it. And then as you make your payments, that's building that equity up in your house. So you're really saving by owning a house. So what makes up your payment exactly? Well, for most cases, this is the breakdown: principal, interest, taxes, and insurance, or PITI as we will say it sometimes. The principal and interest, that amount, if you do a 30-year fixed loan, that amount will never change over the life of the loan. As long as you've not refinanced or anything, the principal and interest payments stay the same. Now, the principal and interest will adjust over time on how much is going towards principal and how much is going towards interest. When you get a loan, no matter what type of loan it is, you're paying more interest than you are principal earlier on in the loan. And then as you get later down to paying that loan off, that principal and interest adjust, where you're paying more principal than you are interest. So principal and interest will never change. Principal goes directly towards the equity of your house. The interest is going towards the lender, and then you have your taxes and insurance. Now, the taxes and insurance make up what we call the escrow account, and your payment goes towards the government for your property taxes and the insurance company for your insurance. Now, there's a lot of myths out there that, oh, this is how lenders make their money, is they build this escrow account up. It's not true. We can't make money off of the escrow account. And we can legally only hold so much in that account. So if you try to overpay your escrows, we're going to end up having to cut a check and refund that back to you. Now, if it's short and we pay those bills and we don't have enough in that escrow account, we may come in and say, hey, we got to rebuild that balance back to where it should be based on the taxes and insurance. That one you don't see as much. Unless you're in new construction, you can see a huge shift in those numbers. But for the most cases, it's just a small increase year over year, unless the government does some kind of tax assessment that maybe they haven't done in a while. So that's what your payment's made up of: principal, goes to the building of the equity of your house, reduces that principal amount of the loan. Interest, which just goes straight to the lender. Taxes goes to the government to pay for property taxes, and your insurance, who goes to the insurance company that you chose before you closed. Or you can actually choose that after the fact as well. So this is a big one, the don'ts. Here are a few things, we got Grumpy Cat there. Here are a few things that you do not want to do while buying a house or maybe right before buying a house. Move money around. It's okay to move money around, just large chunks of money. Don't move it around unless you truly have to. We have to source deposits and any debits that come out of your account if it's large. We have to make sure it's not new debt, or if you're transferring money from a savings, we need to know that you just didn't deposit cash and now you're transferring it from your savings to checking, because when you're buying a house, you can't use cash to buy a house. It's just not allowed. So, moving money around, sometimes we'll have to get multiple statements. We'll have to go back and forth on dates and just making sure we match all those transfers back and forth up. So if you can, save yourself some trouble from having to collect multiple statements throughout the process, and try not to move money around unless you truly have to. If you're paying bills and stuff like that, we get it. We're just going to have to get some extra documentation to source that. Do not apply for new debt during the process. And if you applied for new debt right before you applied for a home, make sure you let us know. Now, we will usually ask if you've applied for any new debt that may not be on their credit report. Don't lie. We're going to find out. So do not apply for new debt, because it could cause the whole deal to go south and fall apart, and then next thing you know, it's been a bad experience for everybody. You thought you were buying a house and now you're not, just because maybe you went and got 0% financing at a furniture company to buy this new furniture for your new house. Don't do that. 0% interest does not mean zero payments, and that could highly affect you getting approved for a mortgage. So don't do it. Do not pay bills late. I have seen this more in couples that might be divorcing or have divorced recently, where they think one person's responsible for the payment and they don't pay it. If you co-sign for a car loan, if you've co-signed, you're just as responsible as the person who you co-signed with. Make sure those payments are getting made on time. That can have a huge impact on your credit and also have a huge impact on you getting approved for a loan. So keep paying your bills and keep paying them on time. Don't switch jobs. Do not switch jobs. If you're in the middle of buying a house and you're getting an offer to get started at this new company with a lot more pay, that's fantastic. Wait till after you buy your house. And maybe even wait a little while after you buy your house. Switching jobs in between buying a house or right before buying a house, it could have a huge impact on you getting approved. And so there's a lot of stipulations. If you're going from a W-2 salary to a commission job, you may not get approved anymore for a mortgage because the way we calculate the income is different. And sometimes we have to have a long history of those incomes. So if you can, don't switch jobs, don't quit your job, or anything like that. So the last one, do not make any major purchases. Do not write a check for any major purchases. Although you may only need X amount of dollars to actually purchase a home, having those additional, what we call reserves, can help you get approved. And by removing those reserves, removing how much you've saved up, can have a huge impact on your approval. And what I mean by reserves is, we look at your total monthly debts and your mortgage debt and see essentially how much you have saved up, that if you lost your job today, how many months you could pay for those debts before running out of money. FHA likes reserves. Conventional loan likes reserves, and so sometimes having a nice nest egg of reserves, cash reserves, that if you lost your job, you could pay for these bills. Having that nice nest egg could be what got you approved for the loan. Maybe your ratios were really tight. Um, Credit wasn't the greatest, but you saved a lot of money. You're showing you're responsible. That's great. We're going to approve your loan. Well, now you've spent that money. You made a major purchase. You decided, I'm not going to do 0% financing at that furniture store. I'll just pay cash. Well, if we have to go back and verify those funds and we see you've spent that money and now we don't have those reserves, you could be denied the loan. So do not make any major purchases without talking to your lender first. Just talk with them, keep them informed. Communication is key both ways. Your lender needs to communicate and you need to communicate with your lender. It's a partnership. We've got to work together. It takes a village to buy a house. It really does. So, last and definitely not least, the one thing I always love to check is the pre-approval checklist. This is your checklist that if you're trying to buy a home, this is the information you may be asked to provide to get a pre-approval. So here's that checklist again. You can pause it. Of course, you can always contact me. BradTheMortgageDad.com will take you straight to my website where you can contact me. I can send you this information digitally if you would like, or I can send you a physical copy as well. But this will get you prepared for when you're ready to buy a home, what you need to start gathering in order for us to get you approved. So that's it. That's our Road to Home Ownership series. We've gone through a lot of information. We've tackled a bunch of things, and now you are ready to buy. How awesome is that? So, Brad the Mortgage Dad here. bhoward@loandepot.com. That is my email. BradTheMortgageDad.com. That is my website. You can go there. I'd love to talk to you if you just have some general questions. Definitely give a call. Happy to talk anything through with you. So our next series is going to be from contract to closing and what to expect. And man, am I excited to go over that series. I think it'll be a ton of great information for you and talking about once you sign the contract or once your contract gets accepted on a house, what happens next? What happens all the way until closing? There's a lot of stuff that happens there. So let's talk about it. Thank you so much for supporting me, for watching these videos. I hope you find them informative and hope you all have a great and fantastic day. Stay awesome out there, and I'll see you in my next series.